Welcome to another episode of the Lightspeed Investing Podcast. So glad to have Steven Orr here back again. He is unscathed from the Hurricane Milton, and here to talk to us about the markets again. Steven, good to see first and foremost that you are healthy and in good shape.
Well, I appreciate that, Phil. I'm looking forward to this talk today. So much to discuss today, and I tell you, going through this is my 29th hurricane. So at this point, I think I'm a professional trader and a professional hurricane prognosticator. So thank you. I appreciate that.
Professional hurricane survivor, right?
Survivor. All right, I love that. Okay, great.
Yeah. So today, I believe we will be talking more in depth about technical analysis and blending that in, right, to showcase what exactly is your approach when you talk about hedging with different asset classes, incorporating it fundamental analysis, which we covered briefly before. But yeah, let's go into technical analysis. You want to kind of share with people exactly what you tend to do when it comes to futures trading, stock options, or foreign exchange? What is it that you like to look for, and what are your philosophies and trading ideas or investment thesis to ensure that you are in the best position for success?
Yeah, that's a great question, Philip. I think everybody that trades today, all trades on charts. When I started trading in 1990 and in 1989, and I was given graph paper and pen and said, what we're going to do is we're going to learn what they call Japanese candlesticks. And that's the very beginning of it. And if you talk to the godfather of technical analysis, a friend of mine, Ralph Acampora himself, will tell you that price dictates everything. It doesn't matter if you have a thesis like myself, or you trade based on the news, or you trade on charts. It's all about price, and price dictates. And what technical analysis does, it tells us where that position has been. Wherever the price of that future or stock or option has been, it is following that. And Japanese candlesticks and technical analysis says, hey, this are usually a trend. And if we can follow trends, we can see where things are going. And outside of that, there's mathematical equations that attach to those trends and technical analysis in general, and lines. I believe in lines. Lines show you where support is. Lines show you where resistance is, where people are not buying, and where people are selling, and where people are buying, and where they aren't selling. That tells you everything, right? But then also on top of that, you have the technical analysis of like MACD charts, right? Regression, linear regression is a big one for me, telling me where the price could go if the issues here are abated. Maybe it's a technical, or maybe it's a news issue going into it, right? It's going to push it. And you can also see that with on-balance volume, or which we can also chart volume and all the things that are also around that. That creates technical analysis, not just about some squiggly lines on a chart. You need to understand the mathematics behind it. You don't need to be a mathematics professor to understand it, but understand what it is that you're actually seeing. And if you know me, I've got lots of charts around me. I'm surrounded by them all day long. I'm happy to show them to you and show you what I look at. And I also am happy to show you how I apply them. I also tell people, if your technical analysis looks exactly the same as it did 6 months ago, you're doing it wrong, because the world changes, and so does what people are using. Technical analysis also says that, okay, great, you see something in the market nobody else sees, but you also should be seeing what everybody else is seeing, because that's where you know where everybody else is buying and selling. So
Mhm.
if everybody has the same technical analysis on their charts, the same squiggly lines, then that also helps you as well. But I also combine, I also believe that technical analysis is not the end all be all. I believe that it is news.
Sure.
I also believe that it is understanding um, the future, right? It's understanding what you're thinking. In my case, when I talked about ag not too long ago, right, is that I like to be playing the futures come now, going into the winter, with the fall, and then of course the planting season's coming in the spring. So I also want to be in the ag side of that. We also know that around 4 times a year, and in this case now a lot more because of the Fed, that we know the Fed meets, we know the Fed are making decisions. That's economics, right? And that's changing futures. And I also know that as geopolitical issues happen around the world, that also affects currencies and the futures of currencies as well. So there are more than what's really cool about it is about 9,000 stocks to trade, right? You can trade the options of it, but futures have a whole lot more because you're trading every month for some things, and other months are opposite months. But there's a lot more to trade and a lot more to thought. But you also can narrow it down. You can have spreads, and that's how technical trading also can help you, is how to lay out those spreads. So I believe in technical trading because that also teaches you where the price has been and where the price is going.
Love it. I love it. And so for you to get even more granular within, let's say, your investment thesis, how much are you looking at between futures, commodities, cryptocurrencies, stock options, and foreign exchange?
Well, I can tell you on one screen of mine alone, I have both gold, I have futures of gold on it. I also have a spot. Look, I think that there's also a situation where you need to hone it down. I don't think that everybody should trade everything.
Yep,
You should trade what you know. That's what I always say. It's one of my rules, right? Trade what you know. And
that's
if
right.
you're really good at trading gold, trade gold. I mean, if you understand precious metals, you're a jeweler, you should be trading gold. You should be hedging gold against your buy as you create jewelry. If you're a farmer, you should be using futures to hedge against that, right? There's a reason why we have a market. It's not just for traders. The markets are there to be very functional, and they're there to produce a market so that farmers can sell their product at a futures price, or you can buy jet fuel because you're an airlines, or you want to buy you're a plastic company and you need oil. There's a lot of reasons why we have these markets. It's not just for traders to trade, but we can take advantage of that, and we can take advantage of situations of whether it's
Mhm.
technical trading or in this case the news. I think one of the cool things we talked about, you and me, right before the show here, was that I talked about weight loss drugs, right? I mentioned this not too long ago on Schwab Network, that hey, as we see weight loss drugs are coming in and people are using them, guess what? People are eating more protein, and more protein is live cattle, and live cattle prices have been going forward. If you started that when Eli Lilly started that, man, you would have made 40, 50, 80, 100, 400, 500% on your money because you had the thesis. Now I think cattle prices are getting a little pricey now. We're at the tops with resistance now, and that tells you everything to me, right? I'm happy to show that chart to you, actually, Philip.
Yeah, no, let's do it. Now, before we go, I want to just remind the audience, you specifically mentioned gold, oil, and then spot, right? So you're not really heavily dealing within technical analysis, anything that has to do with foreign exchange, crypto, right? It more
Oh
so
my
just
goodness, I can't tell you enough. I absolutely trade crypto daily. In fact, I took a lot of Bitcoin off at 68,000. I know that we're hovering around 67, 8 now. But that's where I thought that I liked it at. I bought a bunch at 55, that last sell off, and I took my thesis was it's kind of silly, it's a little cheap, and I bought some. I bought quite a bit. But I'll tell you exactly why. And I'm happy to show that chart too, is why I got out at 68,000. I can also show the difference of where I feel comfortable ability is for me, meaning that I think that this is where everybody else is, and I'm going to beat them to the door. What do I mean by that? I always say I want to be the ticker taker. A ticker
Mhm.
taker is the person at the door that says, okay, you're selling, you're trying to get out of a position when it's low. I'll take your position. Thank you. When the positions are very high and people get in, FOMO starts to hit and pushes higher, and technical says, you know what, it's a little high. I'm the ticker taker saying, I'll sell you into that FOMO. And that's what I do a lot. I don't like calling tops or calling bottoms. That's always a bad way of trading. If you want to trade in a way that looks at charts and see where price has been and where you think price is going based on charts and based on news and based on your thesis.
And of course, you are talking about different asset classes. So what is your approach in terms of, your main priority and focus? Because you can only do so much with so many screens at a time, right? So what is your like top-down hierarchy? What do you focus on most? And then
Yeah,
the other.
it's very simple. It's a great question. It also depends on what's trading too. I like volume. I don't, and I like volatility. I know right now that the stock volatility is very high because we're into October. It's October, right? Crypto is pushing up, right? It's October. We know that. That's the thesis. We know crypto is buying. We're seeing buying because of what foreign governments are doing. They're devaluing their dollar and they're devaluing their own foreign currency. Guess what? That pushes up crypto. That's a thesis, right? But I'm also saying, okay, there's my thesis of October. But I'm also saying, oh, you know what? 68,000 seems to be quite a little bit of a heavy resistance. So why not take some off of that, right? And that's why I'm saying it takes every bit of it, right? It takes a village, I guess, in a lot of ways. Don't ever get wrapped into one way of trading. If you trade one way all the time, every day, all the time, you're going to get wrecked because that's just not it. You need to think about what the market is telling you. In this case right now, I think we just said it, is live cattle. I think live cattle prices were really good. I bought heavily over the last few months based on these weight loss drugs. But I've also seen three massive tops here in the last year. And that's created some serious resistance. And I can tell you that I don't know where the bottom is, but I can sure look at my charts. I can look at MACD, right? Convergence and divergence, and tell me exactly where their bottom is starting to make. I can tell you right from the histogram. I can tell you on RSI where I think that the buyers are going to start to step back in. And I can tell you through on balance volume, all those four indicators I actually use at the same time. They told me one thing, to start to sell my cattle, and I did that. So yeah.
Gotcha. So, Stephen, without further ado, let's go ahead and bring those screens up. I think to keep the conversation relevant, let's focus on the futures and commodity side of things first, right? With your analysis on gold, oil, and agriculture. And
Yeah,
what do you
so
look
let's
for?
talk about that first. So here's live cattle futures, right? I'm going to crunch it just a bit. So you can see what I have. This is live cattle. This is the continuous contract. There it is, right there. Right there's the highs. And this happened back in March of this year. It happened in uh, August of this year, and it's happening again here in October. And we saw three highs lower. And that's when you saw it. Now, I wasn't sure exactly, but my MACD signal line crossed. So right there created me an opportunity to sell, and I did that, right? I'm also looking at it from the perspective of my signal lines on MACD. There they are. And RSI. RSI told me that this was way overbought. And then on balance volume. On balance volume is saying there's more buyers than sellers. Guess what? That's also slowing down. So I started to get four indicators, and then I also saw volume. And now my thesis in the past was that, hey, look here. Look at that buy signal back here in the MACD, right? And my thesis was, okay, weight loss drugs, they're going to be buying more protein, going to be buying more cattle, pushing up. Guess what? It also coincided with my buy signals, and I took advantage of that.
Well, if I'm seeing it correctly, that should also be a hammer, right? In terms of candlestick pattern, signaling, the market to go up on the bottom of that trend.
That's exactly right. And you'll also see the Williams VIX fix. I use it a lot too. It's also telling me the volatility is also slowed down. So selling should pick up. If this thing turn green a bit, where the volatility is higher, you're going to see some selling here, right? You saw lots of selling going all the way down. Right now, this is where we are in the highs. Look at that. It tells you exactly right now, low volume, high volume comes in, VIX, it's going to be some sell off here in the cattle here.
So what's important is, when I think about technical analysis, it really means that you're trading short term. Like for us, right, we deal mainly with the YM when it comes to futures. We're in and out of trades within minutes, half an hour to an hour and a half. Now, when we do that, we're talking about the 1 minute, the 5 minute, maybe even the 2 and 3 minute. Yes, we do like to reference the daily charts as well. And I noticed the first thing that you had on here was the daily chart. So do you mind sharing with the audience your approach of trading in terms of, are you in and out of minutes? Obviously you incorporate fundamental analysis as well. So, do you hedge with the fundamental or do you hedge with the technical? And also, what is the time frames that you usually like to reference?
Man, it's a great question. I can do everything from a day, or I can do lickety split with a minute and seconds. It doesn't bother to me. It
Mhm.
depends on when I see a trade put itself in front of me. I usually let the machine tell me where the trades are because I understand my technical analysis. In this case, they're Bollinger Bands. This is again live cattle. This is these cattle. You're seeing right here when the Bollinger Bands got separated, that was a sell signal. That on the morning of the 14th. right? So today, that was this morning. Look at the live cattle prices. I knew in the dailies that this thing's going to be a seller. So guess what happened this morning? Big selling in live cattle. Volume showed you that. VIX showed you that. RSI showed you that. On balance, all of it showed you that. So why not take advantage of that? Look at these sell signals in here. Big sell signals. And so you can take advantage of that. I did not, but because I'm already short cattle for longer term. But absolutely right. Charts are charts are charts. Numbers are still numbers are still numbers. It all works together. So yeah, totally. With you 100%. It doesn't matter, but as long as you understand the charts.
And so I've noticed on the platform that you're trading, you're using TradingView, right?
Correct.
Correct? Is that your go-to platform for everything as well? Or, for all different kinds of asset class, or what are you doing? Do you switch back
That's
and
a
forth?
great question, Philip. I have several different platforms that I use, and I don't stick to one platform. And then I like IBKR, I like E-Trade for stocks, I like Future for Tasty Trade. There's a lot of things that I just like.
Well, the main thing, right? One would have a favor towards certain brokerages is the margins and the barrier to entry offered by
Correct.
them by
That's
those
right.
brokerages. So, do you mind speaking a bit about your specific preferences? Is it
Yeah,
more
my
for the
preference is
interface or is it margins for you?
Yeah, my preference is IBKR when it comes to those. It's about fills to me. How fast can fills happen?
Oh yeah, that's
IBKR is
important.
very good. Yeah. And so I think that, if you see ticks that are not happening and all of a sudden, you're not getting filled correctly, that's a problem. And it doesn't matter how much money you make or lose if you don't get filled, right? So I think fills are the most important thing. And
Absolutely. Do you find yourself trading the same amount of contracts across each asset class or each brokerage, or do you tend to maybe dial it down or amplify accordingly?
it all depends. I mean, what I'm trading and how I'm trading it, and what my conviction rate is on it. If in this case, a new live cattle was going to sell off, my conviction rate was very high.
Mhm.
I really poured it in on this one. Yes, so that's a very good point. Let's if you want to look at it from the perspective of gold, we can look at
Yeah.
gold. You see,
When you say you really poured it in, how many contracts are we talking about for
a
cattle?
little more than 100. Yeah.
A little more than 100. Okay. So
Uh,
you want to, and then let's kind of talk about gold, but then also make sure we give the audience some perspective because they may not know what 100 contracts equates because each contract for each different assets, right, even within commodities, yields different kinds of profits, right?
that's
So
correct.
if you want to kind of express to the audience what exactly does 1 point off of one contract for cattle equates to versus gold versus oil, then they kind of understand how the numbers equate to profits.
And in this case, live cattle is CME, right? Chicago
Mhm.
Mercantile Exchange. That live cattle can move up or down in one day, $7, 7.5 cents per pound, right? Or $3,000 per contract. So one contract can move. So 100 contracts, multiply 3,000 times 100, right? And then of course you have to worry about what they call that margin and maintenance fees. So your margin is your what it costs for one contract, and right now I believe the margin is $26.95, $2,695 per contract. So multiply that by 100, and then maintenance is after the first day. The next day, to keep this contract rolling, you need to have at least $2,450 per contract on. Minimum tick size is roughly $10 per tick. That contract is roughly one contract. And I think a lot of people don't understand this, but you have to look at it with what the contract is. The contract itself says, I am going to buy or short or sell to somebody else one contract of this thing. And in this case, live cattle, one contract equals 40,000 pounds
Mhm.
of live steer, right? So think about that, multiply it by 100. So that's a lot of cattle.
And
Uh,
what's your average hold time, when you trade these different asset classes?
when it's that heavy, I will be in and out within the day. I will cut that down if it's longer term. I'll probably go down to about 10 contracts or 400,000
You
pounds.
don't tend to hold things overnight, right?
That's correct. Yes,
Yeah, because of
when
the
I'm
increase in
trading like
margin.
this, yes. Now, when I'm trading for longer term, as I am for the daily contracts, I'm got about 10 contracts on for short.
Gotcha. And so now you have gold on, right? So you want
Yeah.
to kind of share with the audience how does gold differ than cattle? One contract, 1 point, right, is It's $3,000. What is the numbers here for gold according to TradingView?
Yeah, I'm gonna pull them up here. Gold contracts. So one gold continuous contract is right now looks like the yeah, it's $1 per side for the screen. So it's roughly $10. Well, so one little tick is $10 per ounce, right? So every little move is $10, right? Now, in the gold world, we have micros and minis too, as well.
Yes.
So there's smaller contracts. So don't think of it like that too, as well. That's why it's a little harder to answer that question. In my case, I just trade what I call the spot or the future of it, right? So that would be the month that we're in. Okay, in this case, I don't trade actual October. I trade the 1 month out, so it's November.
Mhm.
I'm always 1 month out, and at the end of that roll, I roll it over to the next month if I'm longer term, right? I don't try to buy out these gold or March gold of next year. I try to keep that as tight as possible. Tight meaning closest as I can to spot. Spot is what the price of the contract, or in this case, gold, is right now. So in this case, we know that spot gold is 2673.34, and the future here is 2689.70. By the way, that's what we call right? As a spread, the spread between the futures contract and spot, and what we call a forward yield. So in this case, price of gold in the future is higher than it is at spot. So that means that people think that gold prices are even going higher. So yeah, but in this case, I'm going to pull up a weekly chart just so everybody understands first. Look, this thing is hitting highs that we have never seen before, right? Gold's hitting all-time highs. I know that there's calls for $3,000 a gold an ounce. In my case here, I think MACD is telling us no. I also think that people are getting a little bit complacent a little bit. There's no high volume here. We saw high volume selling off. I think if we start to see more volatility into, I think you'll start to see a little bit of selling. Right now, we know the thesis here is that foreign countries are buying gold. So guess what? That's pushing the price of gold up. And we know there's not much, gold isn't being mined faster. So look, supply and demand, right? So demand's high, supply is not increasing based on that demand. I do know that there are certain places like Costco that are now selling platinum, and we know that Costco sold gold and sold all of their gold out, believe it or not. It's crazy. But here we are, and I think, and if we looked at it from the live cattle charts, doesn't matter, charts are charts, price dictates. I'm starting to see a little bit here on the MACD, and you're seeing right here on RSI, we're oversold on gold. I'm sorry, I apologize. We're overbought here on gold, and I'm in the process of now starting to sell, offloading some of my gold contracts as well as.
Now, for you, your indicators are showing up really nicely in a very organized manner. How big is your monitor? Is it like a 32-inch monitor that you're
My small monitors are 32 inch.
32? That makes sense.
Yeah, my small ones. My big one in front of me is 80 inch.
Oh wow, that's why. Is this what are you presenting right now?
Right now I'm only showing you a third of my screen.
No, is this the 32 or is it 80?
It's the 80 inch.
Oh, okay, that's why it's lining up so nicely. I'm like, man, that is there. You can see a lot. I mean, because you have outside of the normal charts, one, two,
Look,
three,
that's a great
four,
point,
five,
Philip.
six, six. You have six additional indicators, right? In that sense, that takes up.
Not to mention overlays. Look, there's two things that I would tell everybody within the trading, right? Get the biggest screen you can possibly get and get the biggest video card you can possibly afford, because those two things will help you trade a lot better because you'll have more than one indicator. I get it. You don't want paralysis of analysis, right? Because you don't want too many things. But if you start to understand how the charts work and how the overlays work, those things really, really, really help you. Because
Do you think it's beneficial to have a bigger screen, one like 180 versus like two 32-inch monitors so that you can like drag things around too and separate accordingly? What do you
No,
like?
the opposite. The opposite. I believe the one screen in front of you should be your biggest screen. In my case, I have a huge screen in front of me, and I have smaller screens to the side of me. I have poles that I have those screens on, and they're
Mm.
separated out. So yeah, I have roughly I have a lot of monitors. I'm
Are
not gonna.
you or is this kind of like your TV length? Like you're on the
Yes,
couch and
yes.
it's
You
like
don't
your
have to have a monitor. Yes, I'm using a TV for this one. Yes.
yeah, yeah, yeah.
And you don't even have to have the latest and greatest. If you know me, I take all of my TVs that I have in my house, and as I get older, I reuse them as screens for myself. So
Right.
you don't have to go out and buy the most expensive TVs, because most TVs can't handle it. But you want to have HD so that you can handle these nice, pretty charts in front of you. But no, you don't have to go out there and buy the most expensive thing in front of
So
you.
let's bring it back, right? Since we're talking about gold, like what would you tell someone who is considering buying physical gold as a physical hedge, right? When in case the world is in a catastrophic state, right? Like uh, physical gold versus trading gold electronically, as you're doing here. What
So
do you
if
have
you're
to say
the
about
world's
both?
going to hell in a handbasket, gold's not going to help you out because you can't eat it, you can't do it, right? People buy gold as a hedge against their portfolios, whether that's trading, whatever they're trading. They also buy gold because it makes them feel good. They can put it in their hands, they can put it in their vault in their house. Gold also is a precious metal that you can use in things like, believe it or not, your cell phone has gold in it. Believe it or not, gold is it's a great conductor of electricity. So
It
gold's
is,
actually in a lot of things.
yeah.
For me, I'll tell you that I do like silver a lot more. Um,
In
and
terms
this
of physical silver or electronic silver.
I like physical silver. I have lots of physical silver in where I'm at, and I'll tell you, I think, and I'm going to pull up a weekly chart of silver here in front of me. I'm actually going to go all the way back. I'm going to go monthly chart of silver, and I'm going to talk about. That's a great question. Philip. If you look back here in the late 70s, early 80s, and believe it or not, Peter Thomas himself, the trader for the Hunt brothers, is actually on my team as well. He's our metals guy. You'll see here that the silver itself, back in September and August of 1979, when the Hunt brothers started to accumulate silver, it went to roughly 42 to over almost $50 an ounce. And that was a rough time for them. And right after that happened, a big massive sell-off happened, back in the summer of that next year. They went to jail, obviously. Then silver started to run again back in 81, and it went through. If you look at that from a chart perspective and a monthly chart, you just talked about bad times and people buying things as a hedge. They did the same thing in '08 when the markets were crashing. Look here, look at that run, in '07, '08, and July of '07 all the way to '08, roughly March, April time. That was a nice run. That went from about $9, $10 an ounce. I remember that quite well, and I dumped a lot of it at around 18.50, $19 an ounce. But immediately right after that next summer, going into the fall, there was a big sell-off in silver. But guess what happened? We had a massive run from '08 to 2012. What happened in September, of 2000? That time there was a big sell-off in the markets. Guess what happened? A nice big run to $50 an ounce in 2011. So this is why I'm telling you, I think that we're going to see another run back to the $50 handle here, and that's not much. We're at 32 now. It's struggling at the 32 because of the Bollinger Bands around it from the monthly perspective, but we are seeing some selling here a little bit. Um, Profit taking is what I think. But if you
Mm-hmm.
start to see a little more geopolitical issues, say Israel or China, yeah, you're going to see people you buying this as a hedge against those geopolitical issues. Now we've talked about this as now a daily chart, and I've said $50 an ounce. Look at this. Clearly MACD is turning. You're starting to see volume starting to slow down. We're going to see a turnaround. That's going to push silver back up. $33, 33.15 is right around that area, is where there's a massive selling. It happened back in a few weeks ago. If we can break around there, we're going to go to $50 an ounce again, because that's what you saw what the past was. So I think the next run here is probably to $36, $37 an ounce. You equate that to futures, and guess what's going to happen, right? You can look at the gold futures or whatever, gold, silver, and platinum. They all pretty much are aligned in a lot of ways. You put a few contracts on as a hedge, and you put it far enough out, say like December. And we call Dece gold, right? December gold. I think you could be a nice winner here. I don't ever tell people what to buy or sell. I just don't do that. But these charts are telling you that, Philip. They're telling you that the thesis is there. You talked about that with geopolitical earlier. You talked about that with charts now. My thesis is still the same. Guess what? That translates into a trade.
I love it. So informative, and we are always so short on time with the amount of knowledge that you're able to pour into us. I'm so glad to be able to get together with you again. Now, really quick, I know you had those charts pulled up. You're always looking, it seems like, for macro trends first, right? Whether it be the weekly, the daily, even monthly and yearly. But when you enter in a trade, do you go, okay, now I know I want to buy here, so you go to like even as narrow as the 30-second or the 1 minute for entries purposes?
I
Or
go to that 1 second chart, but the first charts I look at is a daily chart always, because
right,
why?
right,
I want to know where support and resistance is.
yeah. But
Because
what I'm getting at, when you actually buy the thing, do you compress the time frame into
yeah,
the smallest one? And then once you're in a trade, do you just let it hang and you go back, or do you stay on that small minute chart?
depends on what my thesis is. If my thesis is longer term, like the gold here for longer term, no,
Uh-huh.
I'm not trading a 1 second chart. I'm looking at that. That's crazy. But I am looking at a 5 minute chart. I am
Uh-huh.
looking at the 30-minute chart. And
Mhm.
most people don't know this, but most traders need to know this. If you are an institutional trader, your main charts are 3 hour and 5 hour one day, and 20, and we call 24-hour charts. So I'll tell everybody in the world, look at your 3 hour charts, because your bigger traders, your hedge funds, are looking at 3 hour charts. Does anybody know why? Because it's separated your day into those hours, right? And a lot of trading is 8 hours in stocks too, right? So your 4 hour chart separates the day, right? So that's why they're looking at those charts as well. What's
I
happening?
love it. Thank you. Yeah. Thank you so much for the tidbit, and I'm glad that you brought this point on, because it allows me to set up a segue to our next episode where we can go deeper dive into how federal reports influence the markets. As you know, certain federal reports, one federal report is basically 3 days of trading, right, in terms of volatility. So we'd love to see what your insights are around your charts, and talk more trading with you. Until the next time, Steven, thank you so much for your time, and glad to see that you are healthy and sound from the hurricane. Take care.